Welcome back to this lecture series titled A Brief History of Money, Banking, and Credit. I'm Edward J. Dodson. This is Lecture 5 titled The World After World War. In Switzerland, the Bank for International Settlements continued to operate during the war, even as its board contained central bank representatives of countries at war with one another. During the war, the bank was the recipient of 3.7 tons of gold from the German Reichsbank, gold stolen from the central banks of Belgium and the Netherlands. During the war in the United States, the Treasury issued bonds to be sold directly to the nation's banks, as well as to the general public in post offices and other public places. At the end of the 1942-43 fiscal year, a total of $60 billion of U.S. government securities had been sold. The securities paid interest, of course, and the government then needed to raise revenue by taxation in order to service the growing public debt. Even before the United States declared war on the Axis powers in December of 1941, the nation was spending heavily on armaments and other war supplies. Concerned with rising prices, the government's Office of Price Administration was charged in early 1942 with regulating prices and rationing consumption. By 1943, the federal deficit had increased to almost 27% of gross domestic product. Military expenditures reached $85 billion in 1943 and $91 billion in 1944. In addition to increases in taxation and borrowing from the nation's citizens and large businesses, the Federal Reserve created new money used to purchase Treasury bills carrying an interest rate of 0.3% per year. There was no consideration given to the idea of authorizing the U.S. Treasury to issue currency that could be directly spent into the economy. Economists in Britain and the United States were determined not to allow what occurred after the First World War to happen again. As the Second World War seemed to be coming to an end in 1944, they met at Bretton Woods in New Hampshire to plan for the future. John Maynard Keynes, on the right in this photograph, headed the British team, arguing his case with the American Harry Dexter White. With the United States now the world's creditor nation, participating countries agreed to peg their currencies to the U.S. dollar at the official rate of $35 for an ounce of gold. Dollar imbalances were to be settled between central banks and governments, not by private citizens. Controls were put into place to keep currency exchange rates stable. A new International Monetary Fund was established to extend credits to nations as needed. The final agreement was far from satisfactory to Keynes, who had argued in papers published in 1942 and 1943 that those countries that maintain a trade surplus should spend their surplus money back into the economies of the debtor nations. To accomplish this, he proposed creation of a global bank authorized to issue its own currency, the Bancor, which would be exchangeable with national currencies at fixed rates of exchange. The Bancor would become the unit of account between nations. Harry Dexter White, backed by officials at the U.S. Treasury, opposed the plan. Instead, the world got the International Monetary Fund, the World Bank, and the U.S. dollar as the global reserve currency. As financial journalist George Monbiot wrote in The Guardian back in 2008, the consequences, especially for the poorest indebted countries, have been catastrophic. Acting on behalf of the rich, imposing conditions that no free country would tolerate, the IMF has bled them dry. It has destabilized exchange rates, exacerbated balance of payments problems, forced countries into debt and recession, wrecked public services, and destroyed jobs and incomes of tens of millions of people. For Americans, the Second World War ended the Great Depression and brought on full employment. Rationing and price controls enabled Americans to save an average of nearly 20% of their personal disposable income. Although this pool of savings was quickly spent by 1946 or 1947, a peacetime recession was significantly mitigated. A clear indication of the rise in household incomes is reflected by automobile sales. By 1960, 3 out of 4 U.S. households owned at least one automobile. Government mortgage insurance programs made it possible for returning veterans and other, almost exclusively white adults to acquire a residential property financed over many years. Banks provided the construction financing for new subdivisions made accessible by the expansion of the interstate highway system and other new roadways. Suburban dwellers began commuting by automobile to the urban center or drove to the nearest commuter rail line. The government's role in the residential housing sector began back in 1933 with passage of the Homeowners Loan Act, which created a new entity authorized to provide refinancing to get borrowers out of short-term mortgage loans and into long-term fixed-rate financing that amortized over the life of the loan. Funding to this entity for new loans ended after 1936, but it continued to collect mortgage payments until finally shut down in 1951. The Congress and the Roosevelt administration concluded that much more needed to be done to support home ownership. A 1938 amendment to the National Housing Act established the Federal National Mortgage Association, which came to be called Fannie Mae, as a government agency with the mandate to create a secondary market to purchase for portfolio and sometimes sell FHA-insured mortgage loans originated by private lenders. Then in 1944, passage of the Servicemen's Readjustment Act, what Americans call the GI Bill, created a special mortgage insurance program within the Veterans Administration. Fannie Mae began to purchase these VA-insured loans in 1948. Fannie Mae's charter was modified in 1954 to transform the agency into a public-private mixed ownership corporation. Much of the countryside was changed from agriculture or open space to parking lots for automobiles during these years. An explosion in real estate mortgage debt began in 1949 as an increasing number of workers gained income sufficient to qualify to purchase a property. By 1960, the rate of home ownership had climbed to 62%. Owning a residential property became the primary source of net worth for the majority of U.S. households. Some critics argued much more needed to be done to provide everyone with the goods for a decent human existence. Enter Hyman Minsky to the money debate. He began his academic career in 1949 at Brown University, remaining there until 1958 when he went to the University of California, Berkeley, remaining until 1965 when he joined the faculty of Washington University in St. Louis until retiring in 1990. Over those long decades, he continued to study the cycles of economic boom and bust. In a 1957 paper titled Monetary Systems and Accelerator Models, he admonished those economists who ignored monetary prerequisites. Let us assume that the policy goal is steady growth at a stable price level. The policy measures to be used are monetary policy, which means to choose a monetary system and fiscal policy. Steady growth requires a money supply that increases at a geometric rate, but that a too rapidly growing money supply results in rapid price inflation, and that a too slowly growing money supply results in a downturn of income. Minsky's research suggested the methodology for determining when and by how much the money supply should be increased was needed. Others focused their attention on the problem of personal asset accumulation. the philosopher Mortimer J. Adler began thinking about economic justice as essential to world peace. In an address he gave to the Commonwealth Club in October of 1952, he expressed concern that material progress was accomplished by a weakened sense of civic duty and moral responsibility. He stated, "There is also widespread in American life a relativism about morals. The notion that good and bad, right and wrong are for the most part matters of opinion, subject to taste and individual preference, but not subject to universal principle and law." Adler, a few years later, teamed up with attorney Louis Kelso to write a sharp critique of the American economic system. In two books, The Capitalist Manifesto and The New Capitalists, they expressed their concern over an already growing concentration of income and wealth and offered their solution, universal capitalism. In the preface to The Capitalist Manifesto, Mortimer Adler explains that the ideas on economics are those developed by Louis Kelso, but were ideas he came to embrace. His primary concern had been on how to preserve and nurture democracy. He wrote, "In the 20 years or more in which I have been developing a theory of democracy as the only perfectly just form of government, I slowly came to realize that political democracy cannot flourish under all economic conditions. Democracy requires an economic system which supports the political ideals of liberty and equality for all. Men cannot exercise freedom in the political sphere when they are deprived of it in the economic sphere." Kelso helped create the first employee stock ownership plan in 1956 as a way to transition ownership of a newspaper from its two founders, both then in their 80s, to their chosen successors, the managers and employees. Eventually, the use of these plans found political support and became a widespread benefit to employees. Credit from the United States under the Marshall Plan both helped to rebuild the economies of nations after the end of the Second World War and provide U.S. businesses with new markets. The Bretton Woods system worked reasonably well, at least for the United States, so long as the U.S. remained the world's dominant economic exporting power. Over time, however, imports into the United States began to consistently exceed exports. Huge quantities of U.S. currency were accumulating in foreign banks. Note, however, as indicated by this chart, the net imports as a percentage of gross domestic product was extremely small during the 1970s when compared to later decades. It was economist Walter Heller who became the architect of the Kennedy-Johnson tax cuts designed to stimulate economic output. However, deficits grew as the government spent more and more on the war in Southeast Asia and on the war on poverty. A small part of the answer to the administration's budget problems was a decision to put Fannie Mae on the market, rechartered as a for-profit, shareholder-owned company. Thus, Fannie Mae came out of the federal budget, raising its financial capital through the stock and bond markets. By many measurements, the United States had fallen into the most serious economic crisis since the 1930s. Imports left a huge surplus of U.S. dollars abroad, and as confidence in the dollar weakened, the demand for gold skyrocketed. Johnson finally accepted reality and called for a major tax increase in August of 1967. The tax increase was opposed to by fiscal conservatives in the Congress who demanded cuts in domestic spending, and they got a $6 billion spending cut. This was the situation inherited by Richard Nixon when he became president in January of 1969. Through the first 2 years of his administration, he tried to restart the economy by more or less conventional means. This photograph is of Nixon's nominees to his Council of Economic Advisors before the Senate Banking Committee. In the spring of 1971, foreign holders of U.S. dollars began to convert their holdings to Deutschmarks. Germany suspended its intervention and allowed its currency to float upwards. France and Britain announced they would begin to convert dollars to gold. President Richard Nixon responded by closing the Federal Reserve's gold window and halted the outflow of gold. A 10% surcharge was placed on imports in an effort to force other countries to revalue their currencies against the dollar. This arrangement ended in 1973 with the collapse of the Bretton Woods Agreement. There is no longer a requirement that any bank, even a central bank, hold gold, although many do. Global banking has functioned as a no-reserve system ever since. Paper currencies are issued and held as reserves. Other financial instruments considered liquid, such as government securities, also make up a portion of bank reserves. Geopolitical forces were about to impose even greater stresses on the stability of the international finance system. The word stagflation began to enter the public pronouncements by economists and other analysts. Mainstream economists had come to believe that inflation and unemployment have a stable and inverse relationship. What happened in the 1970s challenged this assertion, as many nations experienced both high inflation and high unemployment. At the same time, the demographics of the U.S. population was rapidly changing, as the generation of baby boomers born in the years directly after the end of the Second World War became adults, and they started to form new families and entered the market for housing, automobiles, and other consumer goods. The time had come for the rapid expansion of residential mortgage lending and the involvement of the three government-sponsored enterprises, Fannie Mae, Freddie Mac, and the Federal Home Loan Banks. The Federal Home Loan Mortgage Corporation, Freddie Mac, was created in 1970 specifically to support the nation's thrifts, that is, savings banks and savings associations, in management of interest rate risk by purchasing their long-term mortgage loans. A year later, Freddie Mac issued the first mortgage-backed security collateralized by fixed-rate long-term mortgage loans. Securitization of these mortgage loans passed interest rate risk on to private investors. On the plus side for investors, the securities were liquid assets in the same way any bond is. Despite the existence of this secondary market, many thrifts elected to hold onto their mortgage loans as a portfolio asset. Thus, when interest rates increased, the market value of the loans fell. Moreover, as the U.S. economy was hit by stagflation, delinquencies and foreclosures climbed. Both Freddie Mac and Fannie Mae experienced huge losses during these years. Beginning in the 1970s, political leaders in the United States and their economic advisors committed the nation to a long process of deregulation of the financial services sector and a reliance on supposed competitive forces to discipline the activities of individual players. In 1978, the Supreme Court ruled in Marquette National Bank versus First of Omaha Service Corp. That nationally chartered banks could charge borrowers a rate of interest based on the maximum rate of interest permitted in the bank's home state. Banks now had a financial incentive to relocate their formal business address to the states with the most bank-friendly regulations. South Dakota responded by eliminating all interest rate ceilings to become the new center for the credit card industry. Delaware soon followed. In 1980, the U.S. Congress passed and President Carter signed the Depository Institutions Deregulation and Monetary Control Act, which served to deregulate financial institutions that accept deposits. A committee was established to oversee the complete phase-out of interest rate ceilings within 6 years. The act also increased federal deposit insurance from $40,000 to $100,000 and required all U.S. banks to hold reserves at the Federal Reserve. This was partly in response to the high rate of inflation, but by protecting depositors from loss, the bankers were given an incentive to take greater risks. The nation's thrifts, the savings banks and savings and loan associations, had already lost a high percentage of deposits to the new money market funds that rapidly increased in size after the late 1970s. As their cost of funds steadily increased, the thrifts experienced increasing losses on their low-yielding fixed-rate mortgage loan portfolios, which they had failed to securitize into more liquid bond-like assets. Hundreds continued to fail into the early 1990s, as this chart indicates. The next phase of deregulation occurred in 1982 with passage of the Garn-St. Germain Act. This legislation authorized thrifts to engage in making loans to commercial businesses, allocating up to 10% of assets, and to offer certificates of deposit in competition with the money market mutual funds. For many of these institutions, the new authority only pushed them to take risks for which they had no expertise in search of high nominal yields and a return to profitability. The industry's deposit insurance fund, the Federal Savings and Loan Insurance Corporation, held around $6.3 billion in reserves at the time, but bailing out all of the insolvent institutions required over $25 billion. Weak federal oversight and passage of the Tax Reform Act of 1986, which greatly reduced the need for those with higher incomes to shelter income by using the thrifts to invest in real estate, created the perfect storm. The Congress was forced to recapitalize the insolvent insurance fund with $10.8 billion in 1987. In 1989, President Bush signed legislation bailing out the surviving thrifts, transferring remaining insurance funds to the Federal Deposit Insurance Corporation. A new regulatory agency, the Office of Thrift Supervision, was created. To oversee the dissolution or merger of troubled institutions, the Resolution Trust Corporation was created. Nearly one-half of all savings institutions disappeared, costing taxpayers around $210 billion. Between 1989 and mid-1995, the RTC closed or otherwise resolved 747 thrifts with total assets of $394 billion, but with much higher aggregate liabilities. Another major component of financial deregulation was the gradual unraveling of the Glass-Steagall Act. This process began in December of 1986 by a Federal Reserve ruling permitting banks to generate up to 5% of gross revenues from investment banking activity. This was soon expanded to permit banks to handle commercial paper, municipal bonds, and mortgage-backed securities. The pattern of gradual deregulation accelerated after August 1987, when Alan Greenspan was appointed chairman of the Federal Reserve System. The final step came when President Clinton signed the Financial Services Modernization Act in 1999. This legislation opened the door to consolidation of the financial sector, as commercial banks, investment banks, securities firms, and insurance companies were allowed to acquire one another or merge. White House papers made public in 2014 reveal there was only limited discussion of the risks of such deregulation. Another voice crying out from the wilderness was that of Thomas Greco Jr., a former business professor who determined that systemic monetary reform was needed above almost all else. In 1989, he produced a short book titled Money and Debt, A Solution to the Global Crisis. The reforms he called for were systemic, requiring a degree of global cooperation with almost no chance of success, at least at the time. A recent quote from him provides some insight into risks he associates with the existing monetary system. Recognition that almost all political money is created by banks making loans, and that the interest/usury that is charged on those loans causes a debt growth imperative, which is the driver of artificial economic growth that now threatens civilization and the very existence of life on this finite planet. This system is also the driver of increasing disparities of wealth and power that is destroying what little remains of democratic government and is moving the world toward a fascist, neo-feudal world order. When Bill Clinton entered the White House in 1993, his administration faced huge economic problems. The federal government was spending far more than it was taking in. There were 10 million people unemployed, and inflation was eating into household incomes. During the next 8 years, many of these economic measures improved. The question was whether this was because of the administration's policies or despite them. Under Clinton, the top income tax rate was increased from 28% to 36% for individuals with incomes above $115,000 and to 39.6% for incomes above $250,000. For corporations with taxable income above $10 million, the tax rate was increased from 34% to 36%. Welfare reform also significantly reduced the number of people on public assistance. However, none of these revenue-producing and cost reduction measures prevented the nation from the next cyclical downturn in 2001. The Federal Reserve responded as theory demanded and cut interest rates to stimulate borrowing. Would the borrowing go into real economic production, or would much of the borrowing be channeled into real estate, driving up property and land prices, but not creating much in the way of new business investment? With the Electoral College victory over Al Gore, George W. Bush came to the presidency ready to roll back the Clinton-era tax increases. The bill he signed in 2003 reduced the tax rates on long-term capital gains and dividends to 15%. It should have been apparent to anyone that this increase in disposable income provided new financial fuel for speculation in real estate and the stock market. Bush's economic team ignored the option of providing tax incentives for investment in actual capital goods instead of financial assets. Passage of the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005 made it more difficult for individuals to use bankruptcy to get out from under a debt. Their one option would be to take equity out of their homes in order to raise cash. For those already having difficulty maintaining a good credit rating, they had no option but to take out subprime mortgage loans at high rates of interest. By 2005 and 2006, the subprime lenders captured 20% of the market. Defaults skyrocketed, and when the property market cycle began its inevitable downturn at the end of 2006, foreclosure-related losses mounted, as indicated in this chart. The value of the private label mortgage-backed securities issued by banks plummeted. The financial panic had begun. As this chart indicates, the U.S. government has for all of the post-Second World War era spent in excess of revenue. The level of public debt has increased at an increasing rate since the passage of the Reagan-Bush tax cuts on capital gains and high marginal incomes. With each passing year, the challenge of raising revenue to service this public debt has worsened. As the global economy struggled to emerge from the 2008 financial and economic crash, an almost endless list of analysts have offered their interpretation of what happened and why. One of the most important was published in 2010 by the Council on Foreign Relations. The book is titled More Money Than God, and the author is Sebastian Mallaby. Mallaby describes in remarkable detail the circumstances that stimulated the creation of hedge funds as major players and speculators in the financial markets, their enormous gains, and corresponding losses and collapses. He also explains in clear language the power and privileges acquired by the global investment firms and commercial banks. What distinguishes this book from many others is its exploration into what motivates individuals to act as we do in the pursuit of financial gain and the power to direct markets. He describes the frenzy of the mid-2000s in this way. Volatility was low because the world was awash with wild money, but abundant liquidity was giving the false sense that stability was due to some magical structural improvement in the financial system. Investors from Asia to Arabia were wiring billions of dollars to fund managers in New York, buying every piece of paper that Wall Street's mortgage desk could sell. The widespread fraud that characterized the subprime mortgage business became apparent when borrowers failed to make even the first payment due on their loans. The first but very large domino collapsed. As Malaby writes, rather than running their books in a way that rigorous analysis suggests will be safe, banks sometimes run their books in a way that the capital requirements deem to be safe even when it isn't. Subprime mortgages presented a classic example of this problem. Bonds backed by toxic mortgages were given the top AAA rating, partly because the rating agencies were paid by the bond issuers, which dulled the incentive to be critical. Once the AAA seal of approval was affixed to subprime assets, banks were happy to hold them because capital requirements allowed them to do so without putting aside much capital. Regulation and rating agencies thus became a substitute for analysis of the real risks in mortgage bonds. And here is the perfect metaphor for where these beliefs and policies brought us. Watching as the monetary system crashed and the economy with it, Thomas Greco Jr. offered a solution in the 2009 book, The End of Money and the Future of Civilization. As he explains, when I speak about the end of money, I am referring to the growing recognition that money has become nothing more than an information system, and to the emergent mechanisms for managing exchange information outside of the conventional banking system and without the use of political monies. In my view, that must be a shift from elite rule based on command and control hierarchies and military force to a more inclusive, participatory, just, harmonious, and sustainable order. Midway through 2024, the problems remain, and the proposed solutions are still to be thoroughly evaluated and the best of them implemented. And so we reach the end of Lecture 5.